Hello and welcome. Before we start, please subscribe to our YouTube channel for news and updates. Stocks sold off early last week but rebounded to finish higher after the administration announced a UK trade deal. The Russell 2000 led the gains and outperformed the S&P 500, with outperformance from the equal weight, value, and high beta factors as well. Cyclical sectors broadly outperformed, while defensive sectors lagged the broader market. In another sign of risk on appetite, high-yield corporate bonds outperformed in the credit market, while investment-grade and treasury bonds traded lower. Volatility eased across markets, with both the VX and MOVE indices falling as tensions continue to de-escalate. Meanwhile, the US dollar strengthened and oil prices rose despite OPEC signaling plans to increase output. Key takeaways for this week. 1. The US trade deficit surged to a record high in March as businesses accelerated imports ahead of Trump's tariffs. The widening trade deficit underscores the complex effects that trade policies are having on economic data. Implication: the threat of tariffs is influencing business and consumer behavior, making it difficult to gauge the true health of the economy. 2. The import surge weighed on economic growth in Q1, causing GDP to contract by 0.3%. It was a sharp slowdown from Q4's plus 2.4% growth and the first contraction in 3 years. The main driver was a plus 41.3% surge in imports as businesses accelerated purchases and built up inventories ahead of tariffs. Implication: imports weighed heavily on Q1 GDP, but as import levels normalize, the trade drag could reverse and temporarily lift GDP growth. 3. While headline GDP growth was negative, core growth remained solid, excluding the trade distortion. Consumer spending slowed but remained positive, and residential construction grew for a second quarter. Non-residential investment benefited from business spending on equipment, structures, and inventory restocking. Government spending was a notable shift from recent quarters and weighed on growth due to federal spending cuts. Real final sales to private domestic purchasers, which excludes trade, net exports, inventories, and government spending, grew plus 3.0% compared to Q4's plus 2.9%. The measure provides a clearer view of core private sector demand and signals the economy's underlying resilience leading up to tariffs. Implication: despite negative headline GDP growth, private sector growth remained solid. 4. The labor market remains strong despite policy uncertainty. The U.S. added 177 jobs in April, and unemployment held steady at 4.2%. Our view: policy and trade uncertainty have put hiring and firing decisions on hold as companies wait for clarity. Implication: April's job growth suggests the labor market is holding up despite policy uncertainty. The strength of the report alleviates recession concerns but also pushes back the timing of rate cuts. 5. The Fed held interest rates steady at its meeting this week as expected. The statement emphasized a cautious, data-dependent approach and warned about elevated inflation and unemployment risks. At the press conference, Powell stated that the current policy stance is well positioned and emphasized the need for more data before making any moves. It's unclear how the Fed can avoid being late, as it will likely wait for the labor market to weaken before cutting. The risk: unemployment is a lagging indicator. Implication: the timing of rate cuts is being delayed as resilient hard economic data supports the Fed's patient approach. The probability of a June rate cut dropped sharply from nearly 70% to just 22% over the past week. 6. Different areas of the market are sending mixed signals about the outlook. The S&P 500 and high-yield bonds have recovered all their losses and are flat. However, gold prices in the VIX remain elevated, and oil has plunged nearly 20%. Implication: equities price in little to no impact, but gold, the VIX, and oil signal concerns about slower economic growth and continued market volatility. Thank you for listening. For additional information, please visit MRAadvisory.com.